everyone, and welcome back to Gold Off the Charts. 2026 is already proving to be a year unlike any other. Just days into the new year, the global rulebook has been completely rewritten. Concepts we took for granted, like international law, sovereign immunity, and dollar credibility, have essentially become scrap paper following a few tactical strikes and a series of press conferences. If you've been on your phone lately, your feed has likely been dominated by one story: the U.S. lightning raid on Venezuela and the capture of President Maduro by U.S. Special Forces. Most people are just watching this for the spectacle. Some say it's like a Hollywood movie come to life, while others think Trump is just trying to distract from domestic issues. But as a market veteran who spent years navigating the financial trenches, I have to warn you, this is much more than a simple military operation. This is a desperate last stand for the petrodollar system. We are witnessing a historic pivot where the United States is shifting from a world policeman to a world repo man, seizing assets. According to the latest reports, U.S. forces executed a precision raid with incredible speed, arresting both President Maduro and his wife. Pay close attention to the details here. This wasn't a proxy war or a behind-the-scenes coup. This was a direct, overt military arrest of a sitting head of state. Even as we record this, Maduro has already been extradited to New York to face narco-trafficking charges in a U.S. court. The sheer audacity of this move has shattered long-standing unwritten rules of international diplomacy. This is why I'm calling this a massive black swan event. But guys, we need to look past the headlines. We can't just be spectators. We have to ask, why now? Why Venezuela? And what is the deep financial logic driving this? On the surface, it's framed as an act of justice or part of the war on drugs. But if you follow the money and look at the flow of the dollar, you'll see this is actually a battle to defend the petrodollar. Venezuela holds the world's largest proven oil reserves. For years, they've been at the forefront of de-dollarization, trying to settle oil trades in other currencies to bypass the SWIFT system. For a U.S. economy deeply tied to the dollar-oil peg, this was an intolerable challenge. Consequently, the U.S. chose the most primitive tool available, brute military force, to maintain the dollar's status. But here is the massive paradox and the core reason I am so bullish on gold. The more force the U.S. uses to defend dollar hegemony, the faster global trust in that dollar will evaporate. It's a classic boomerang effect. This is why, at Monday's market open, spot gold gapped up, smashing through resistance levels to hit a fresh high of $4,400 per ounce. Silver followed suit like a wild horse, surging 3% and testing the $76 mark. Think about it from the perspective of a non-Western leader or an emerging market central bank governor. When you see a president captured and flown to New York for trial, and you see Venezuela's 31 tons of gold in the Bank of England frozen and seized, what goes through your mind? Do you still feel safe holding U.S. dollars? Do you think your national reserves are secure in U.S. treasuries? Absolutely not. You'd feel a chill down your spine. And that fear is the single biggest fuel for the gold market. Nikki Shields from MKS PAMP put it perfectly when she asked, where will those 31 tons of seized gold actually go? This isn't just Venezuela's problem, it's a systemic asset security risk for the entire global south. To protect their wealth from being harvested next, central banks have no choice but to accelerate their gold accumulation. Gold has no borders, no counterparty risk, and it's the only asset that doesn't require permission from the U.S. government to own. And the situation is still escalating. This geopolitical storm feels like it's just getting started. President Trump's victory speech after the operation only added more fuel to the fire of market uncertainty. In his latest remarks, he didn't try to calm the international community. Instead, he hinted that this was just the beginning, even name-dropping Colombia and Cuba as potential targets. He even doubled down on U.S. interest in Greenland, which immediately drew a sharp protest from Denmark. Trump is essentially telling the world that the big stick policy is back. This has caused geopolitical risk premiums to skyrocket. The market originally thought Trump would focus on domestic growth and isolationism, but this unilateral power move has brought total chaos. Now, let's take a long-term view. Combining geopolitics with supply and demand, what is the outlook for gold for the rest of 2026? There is a powerful consensus forming that this gold bull market is unstoppable. This isn't just my opinion, it's the prevailing view from Wall Street giants down to retail traders. A recent Kitco News survey shows that market sentiment is bordering on a frenzy. Among retail investors, a staggering 42% predict gold will hit $5,000 or even $6,000 in 2026. Nearly 30% are firmly in the $6,000 camp. Only about 10% believe prices will drop back below $4,000. What does that tell you? It means the gold to the moon narrative is now deeply ingrained in the public consciousness. This massive bullish sentiment is a self-fulfilling prophecy. When everyone believes $5,000 is coming, the current $4,400 price tag looks like a bargain. We're also seeing a recovery in gold premiums in India and China, which shows that physical consumer demand is rock solid. Meanwhile, institutional investors are leaning in the same direction, even if they are more conservative with their targets. In 2026, the Federal Reserve is facing immense pressure to pivot. Chairman Powell's term ends in May, and Trump has made it very clear he wants to replace him with someone more aligned with his vision. The market expects the next Fed chair nominee to be a total dove, someone who will support aggressive rate cuts and loose money. This fits Trump's low rates, weak dollar, pro-export agenda perfectly. Interest rate futures have already priced in at least 2 rate cuts for 2026. Some analysts even think the Fed might restart QE, just to help finance the exploding U.S. national debt. Bart Mellick of TD Securities pointed out that the talk of rate cuts, combined with U.S. debt risks and trade wars, creates the perfect macro cocktail for gold. Once the money printer starts roaring again and dollar yields fall, gold, the ultimate hedge against inflation and currency debasement, will have nothing holding it back. However, I want to give you an objective reality check on the short-term game. While the long-term trend is up, the road will be bumpy. We're seeing a complex tug-of-war between the US dollar and gold right now. Interestingly, after the Venezuela incident, while gold spiked, the US dollar index also rose to a 2-week high. Why? It's a classic safe haven paradox. During extreme geopolitical crises, capital flows in 2 directions. Some goes into gold for absolute safety, while another part, usually those needing high liquidity, rushes back into US dollar cash. In a traditional panic, the dollar is still the go-to liquid asset. So, we might see a period where the dollar and gold fly together. A stronger dollar can temporarily cap gold's gains. This explains the volatility we saw last Friday. But listen closely. This suppression is only temporary. Liquidity needs drive the dollar, but a credit crisis drives gold. These are 2 different logical levels. As U.S. debt spirals and the dollar is increasingly weaponized, like we saw with Maduro's arrest, the very foundation of dollar credit is being eroded. When the world realizes that holding dollars comes with the risk of being sanctioned or confiscated, the safe haven title will shift permanently from the dollar to gold. For 2026, I believe $4,400 is just the launch pad for the next leg up, not the peak. We now live in a world where shocks and surprises are the new normal. We used to think arresting a sitting president was a movie plot. Now it's a reality. We used to think $3,000 gold was a bubble. Now it's established at $4,000. In this era of uncertainty, scenario planning is vital. If geopolitics continue to worsen and the U.S. keeps stoking fires globally, gold will soar as the ultimate fear hedge. If the U.S. economy enters a recession and the Fed prints money to save it, gold will soar as an inflation hedge. If de-dollarization picks up speed and central banks keep buying, gold will soar on pure supply and demand. No matter which script plays out, gold is positioned to win. This is why I always say gold isn't just about making a profit anymore, it's about protecting your financial right to exist. Its role in diversifying your assets and protecting against downside risk cannot be replaced by any paper currency. Ultimately, that raid in Venezuela was the opening bell for a very turbulent 2026. We are moving from a world of rules-based order to a world of might makes right. In this new era, the promises of fiat currency will become worth less and less, while the gold in your hand will shine brighter than ever. I believe $5,000 is only a matter of time. This isn't just a wild guess. It's the most logical price adjustment for a collapsing international financial order. Finally, a quick reminder of the basics. Everything I've shared today is based on my own observations of current market data, news reports, and logical deductions. I'm here to help you clear the fog and see the truth, but this is not direct financial advice. The market is inherently risky, and trading requires caution. Everyone's risk tolerance is different, so please do your own due diligence. Investing isn't gambling, it's about finding high-probability opportunities in an uncertain world. That's all for today's deep dive. If you found these insights helpful, or if I helped you connect some dots you hadn't noticed before, please let me know in the comments. Don't forget to like and subscribe to Gold Off the Charts. See you in the next one.